So overhead adds one additional issue for us because we have to figure out a predetermined overhead rate. So because we're using an estimate to then define another estimate, it can get a little more complex. Because in theory, we actually never know how much electricity was used. So making our actuals is a little more difficult too. So we're going to have to use this predetermined overhead rate times a standard activity for assigned overhead. So memorize that formula. Assigned overhead equals TOHR, predetermined overhead rate, times standard activity. So with anything with overhead allocation, we need to determine an allocation base. We then need to choose the predicted level of activity and then compute the standard overhead rate. That's how we determine a standard. That's how we determine standard overhead rates. So again, we have to build an estimate to develop this standard. I'll give you the standards for your quizzes and tests. It's just you're going to have to use them to figure out your variances. So here, they're saying based on an 80% activity level, we can determine a standard overhead rate. So let me give you this example here. They're saying we're going to determine, we did this in prior classes for overhead allocation, but they're going to determine their standard overhead rate as $8,000, the total factory overhead they're expecting to spend, divided by the direct labor hours of 4,000. So here, standard overhead rate, they're saying direct labor hours is 4,000. We're saying total factory overhead is expected to be 8,000. You divide the two, you get $2 per labor hour. Right. But this just goes back to how we assigned overhead previously. It's just a refresh. So if I ask you to do that, you should be able to do it by now. We've talked about predetermined overhead rates quite a bit. So how do we compute overhead variances? Well, let's just start with what was applied versus what was actually incurred. So we can see what we applied based on our accounting, right? We'll have our journal entries. We'll see that we applied a certain amount of overhead based on our overhead rate, and then we'll get the bill for it. And so we can make a determination if we applied too much or too little. Our overhead variance is equal to actual overhead incurred minus standard overhead applied. So if we had a $10,000, if we had $10,000 in overhead that actually occurred, but we applied 9,000, we'd have an overhead variance of 1,000. Negative, it would be a negative variance. I'll change up the formulas a bit. The sheet, I think it's easier. A negative variance because we paid more than what we estimated. So that's something that tricks a lot of students up. Always just take it back to logic. If you paid more than what you expected, it's a negative variance. So try to remember that. So here they're saying, as another example, GMAX produced 3,500 club heads working 3,400 hours. Same example we're carrying forward. We budgeted 4,000 units. Our actual variable overhead was 3,650, and our fixed overhead was 4,000. So what's our actual overhead incurred? Change it here, 3,650 plus 4,000. That's 7,650. What's our standard overhead applied? Well, we have the 3,500 club heads times the overhead rate. So here we have a negative $650 variance. It's unfavorable variance because we spent more than we expected. Now we have to identify why we did that. So we go into the subvariances. So we have to figure out our controllable and volume variances. So these are just the terms. Overhead controllable variance is actual total overhead occurred minus budgeted total overhead. And there are overhead volume variances, budgeted fixed overhead minus applied fixed overhead. So we can go with this example. Total overhead. So let's do overhead variance. Total overhead variance. Overhead volume variance. So our total is 650. I would calculate the overhead volume variance first, and then use it to input the overhead volume variance and the controllable variance. So this $500 is coming from here. That's a better way to think of it. So calculate the overhead volume variance first, and then calculate the overhead controllable variance. There's more variances within overhead. I'm not going to teach them to you in this class. I think that it's enough to try to grapple the concept of variances and figuring fixed versus variable for overhead, and then figuring out direct materials and direct labors and understanding what's favorable versus unfavorable. That's where I want you to start out within this class. And you're going to just know there's a lot more different analytics you can do for, and variances analysis you could do for overhead that you'll learn in cost accounting if you continue this further. The whole goal is to isolate out the issues of overhead. So to re-summarize this, we know we had a total overhead variance. What's causing it? Well, what's causing it is amount of volume used, right? Again, a quantity variance. And then of that volume used, there's only so much that we can actually control because there's a fixed component and a variable component. And so the controllable amount is that difference in variable components. That's what we're trying to figure out. Any questions there? Grapple with a few of these on your homework. I'm giving a few just so you can kind of try to figure it out and understand it. We'll keep going then. The next piece is sales variances. This is quite easy. Right? All we're figuring out with sales variances, to go back to a little something more simple, is
You're on mute, Professor.
oh, sorry, I don't know how that happened. Can you hear me now?
Yes.
Thank you. So let's talk about sales variances. Same concept as direct material, direct labor, right? Just we're talking about quantity and selling price. So what are some ways that we could have a sales variance? Open question for the class.
Price and quantity?
Yeah, well, exactly. So we could sell too much. We could sell more than we expect, or we could sell it for a higher price. Hopefully pretty straightforward. So that's what we're saying here. We have some golf balls and golf clubs and our expected price versus our actual price. So I'll just do it for golf balls. Units. So budgeted units. Cool. 1,000 units. 1,000. sales. And then so this is where we talk about standards. What I'd say is budgeted. I'll say budgeted price, and then you can get your standard. Budgeted price is 10. So we'd expect to make $10,000 off golf balls. The actual price, for actual units we sold are 1,100. Actual price is 1050. Actual sales 11,550. And then we can say, what is our variance? Our variance is 1,550. That's a positive variance because we sold more at a higher price. Then we can figure out the price variance and the quantity variance by diving into what we did before. Our price variance is our actual sales times our actual price. You can just use up the above formula. Price variance, I'll make it quicker here so you have something different. Price variance is our actual sales times our actual price, which is here, minus our actual sales times our budgeted price. Oops. Oh, let's see, 550, it's favorable, right? We sold it at a higher price. Another way to calculate this is just to take this 50 cents times the actual units sold, right? We sold 1050 for 1050. There's many ways to get these numbers. That's what I'm trying to show you. It's like there's some logic to it. And then volume variance. We take the actual sales times the budgeted price minus budgeted sales times the budgeted price. And we have $1,000 positive variance here. Oh, sorry, $1,000 unfavorable variance here. Budgeted price. Oh no, $1,000 favorable because we're just looking at the golf ball. So just look at the top here. I don't want to do the drivers too because I think it's self-explanatory. And so this makes sense. These two together equals 2,550, which was our total. Let's see, our total variance of the actual sales, 10 variance. Our 550 plus our 1,000 equals our 1,550. The total variance. That's our check. 1,550 minus 1,550. Check should be 0. So that's the nice thing about this variance accounting is we should always be able to check when we start going into our further variances if we're figuring it out correctly. If you add both your price and volume variances together, they should equal your total cost variance or your total sales variance. If they don't, you need to check your math. So you have a built-in check to this. And so this is what you'll learn in cost accounting. I'm not going to try to confuse you with it. I think it's too much. But the whole I'm just going to talk you through the high level concept. I'm not going to go through the math. But the concept here is that you have variable overhead and fixed overhead. And we figured out controllable variance versus we were figuring out the total variance versus the efficiency variance, I think it was. Oh, controllable variance versus the volume variance. Another way to say efficiency variance. Well, in reality, we could really try to dive into what are the variances within fixed overhead and what are the variances within variable overhead. And these components build up a controllable variance and then our volume variance. Because overhead is already already an estimate type of concept, I don't think you're going to benefit much from learning. I think this just might be too complex at this level. Just be aware that we can continue to derive estimates of different types of variances based off of our cost information. And so the more information we have, we can try to find out more variances as we dig into it. So if you wanted to, you can read into this and we can stay after class and I can talk you through this at some time, but it's not necessary for your homework or tests. And I'm not going to hold you accountable for it. Same thing with the journal entries. I'm not going to hold you accountable for journal entries for variances because they would be internal journal entries. They're not external journal entries. So I wouldn't be worried about those two. I'm going to try to save you all that effort. So what do I want you to learn from this lecture today? And what do I want you to take away? Let's go through it really quick and then I'll open up for questions. First part, flex budget. I want you to understand the difference between a flexible budget and a standard budget. What is a flexible budget? A flexible budget, you change based on a certain level of activity, generally sales, because sales drives production. But when you have a flexible budget, you need to have a concept of standard costs in order to determine the proper cost at each activity level. So that standard cost is what we've talked about. We have for the next part, we talked about there's standard costs for direct materials, direct labors, and variable overhead. We can also talk about fixed overhead and variable overhead standard costing, but we're going to save that for your cost accounting class. For each type of standard cost or each bucket, right, this should be familiar to you by now, direct materials, direct labor, overhead. That's been since class 1. We can break it into a price variance and an efficiency variance. And each one has a different definition or term based on the type of product. For direct materials, we have price, direct labor, we have rate, variable overhead, we have rate for our price buckets. And then for our efficiency buckets, we have quantity for direct materials, time for direct labor, and activity for variable overhead because variable overhead is applied on a predetermined overhead rate. We can calculate, standards will generally be given to you in this class for your homework. If you spend more than you make, or you spend more than you expect or budgeted, it's bad. If you spend less than you budgeted, it's good. That's the favorable versus unfavorable. And we use this in order to make educated decisions on how to refine our business from a management perspective. Then we went through how to make the calculations, which you have the Google Sheets. We have to figure out our actuals versus our standards in order to derive these differences. And then the last piece we talked about was this overhead concept of how do we determine what's the controllable component of our variable overhead. That's what I want you to take away, be able to do the math behind it, be able to determine if a variance is favorable or unfavorable for direct material, direct labor, and then the overhead components we discussed. The test and quiz will be primarily focused on direct materials and direct labor, but there will be maybe one question on your final for the overhead. Any questions? I'll stop the recording for questions.